Welcome back. Sunny Agarwal from SBI Securities now joins in to take the market conversation forward. Sunny, good morning. Thank you for joining in. One of your preferred ideas has been the auto ancillary space. There's been a lot of chatter about the auto sector. But what about the auto ancillaries? What makes you so bullish on this?
Good morning and thanks for having me on the show. I think, yes, definitely. I think post GST rationalization, we have seen that there has been a strong uptick in volumes across the auto subsector, whether it is passenger vehicle, two-wheeler, three-wheeler, or for that matter, commercial vehicle or tractor. Although commercial vehicle and tractor seems to be better placed when we talk about second half of FY26, wherein first half was not so good for this space, but looks like second half will be a very robust in terms of volume delivery. And we believe ultimately the best way to write this story is through auto ancillary companies, because auto ancillary company has got an added advantage in form of wherein they cater to a domestic OEM. At the same time, we have seen that many international players are making India as an export hub. So that is something which is giving them another leg up in terms of growth. And moreover, most of the auto ancillary companies, if you look at, they have diversified in terms of product offering, either by growing organically, inorganically, or tying up with an international player. So I think the valuation at which the auto ancillary space is sitting, it seems that most of the companies in the range of 5,000 to 15,000 market cap band are well placed to deliver kind of 20-25% earning CAGR over the period of next 2-3 years.
Right. I'd like your thoughts on a couple of these tire companies. Since you're speaking about auto ancillaries, what are your views on tire companies? Because all of them are doing extremely well today. JK Tire is up 7%. CEAT is higher. We've seen some traction build up in Apollo tires as well. Crude prices are lower. And if auto sector is likely to do well, tires are beneficiaries. And they're also, platform agnostic. You could be driving an ICE or you could be driving an EV. Tires will be required for both?
Yeah, definitely. I agree with you, Mangalam. And one more thing, apart from all the points which you have discussed, is that we have seen of late there is a stability in the rubber prices, and whatever the price action most of the tire company has to take, that has been taken care of during the first half of FY26. Seems like tire companies are very well placed to deliver a healthy earning growth. As you rightly pointed out, with the benign crude oil prices, the carbon black, which is one of the key input material, there also the companies are likely to be one of the key beneficiary. And at the same time, as historically we have seen, as the auto sales volume pick up, ultimately the OEM demand obviously is likely to do well. Going forward, replacement demand also tend to do well. So we believe among the tire play, CEAT, which is more of an two-wheeler or passenger vehicle and with a strong brand presence, CEAT is one of the stock which we are recommending to our clients.
Sunny, in the NBFC pack, you've picked Shriram Finance as one of your top picks. But, on the back of this anticipated news, the stock has also been running up. I mean, from the start of the year, 600 levels, we've gone to 860, 862. How much of an upside do you see from here for new investors to enter? What sort of an upside is there if the deal materializes?
As you rightly pointed out, that definitely we have seen a strong run-up in Shriram Finance over the period of last 1 or 2 months on the back of the deal, which is likely to get announced today. But what we feel is that ultimately a long-term growth story is still intact, although trading at closer to 2.3, 2.4 times 1 year forward price to book. But we feel that post this capital infusion, obviously there will be a reduction in the cost of fund, and that should aid in terms of margin expansion. And overall, if you look at the category to which Shriram Finance is catering to, there we feel that a credit growth of 14 to 15% is highly likely. Although in the short term, it may consolidate for some time, maybe buy on dip is the right strategy. What we feel is that a fair value of the business is closer to 950 rupees if somebody has got an investment horizon of 12 to 15 months.
Okay, Sunny, we'll leave it at that. Thank you so much for joining in. We wish you a very happy new year as well if we don't speak again. But on that note, we're going to take a short break. Don't go anywhere. When we return, we'll get you excerpts from an exclusive interview with Jeet Adani of Adani Airports. So stay tuned.